Welcome back to the Deep Dive. It is January 24th, 2026. And I have to say, looking at the title of the analysis we've prepared for today, it it feels a little bit like a cruel joke.
Oh, yeah. Which part is bothering you?
The word clarity. We're doing a deep dive into the Clarity Act. But if you are an investor looking at your crypto portfolio this morning or, just reading the headlines, clarity is probably the very last word you would use.
That is entirely fair. I mean, it is messy out there. We're seeing a level of legislative chaos and just pure market confusion that we haven't really seen since the early 2020s.
It really does feel like we're in a fog. We have laws passing, we have laws failing, and the technology is just moving faster than anyone in D.C. can keep up with.
Right.
So the mission today is to cut through that fog. We have a stack of legislation, some pretty heavy research papers, and some, frankly, terrifying physics updates. We need to figure out, is your portfolio actually safe?
And we aren't just asking if it's safe from a market crash. We're asking, is it safe from Congress? And this is the big one. Is it safe from the laws of physics?
Physics. Yeah, we usually stick to economics and market theory here, but today we are going quantum.
We have to, because while all the politicians are arguing over jurisdiction and, definitions, there is a technical threat looming that makes all of this look a bit like rearranging deck chairs on the Titanic.
I do love a good existential threat to start the morning. So, here's the roadmap for you. We have 3 layers to get through. First, the law that's actually real, the Genius Act.
The one that passed.
Second, the law that just failed,
Right.
the Clarity Act. And third, this harvest now, decrypt later threat that might just make both of them irrelevant.
It is a lot to cover. But if you want to understand the safety of your assets, we have to look at not just what creates value, but who regulates it.
Okay, let's unpack this. Let's start with the one that's actually on the books, the Genius Act. President Trump signed this back in July 2025.
The Guiding and Establishing National Innovation for U.S. Stablecoins Act.
The acronyms are definitely getting better. I'll give them that.
They're trying.
But this act, it fundamentally changed the plumbing of the financial system. If you hold a stablecoin today, USDC, PYUSD, any of them, you aren't holding the same thing you were 2 years ago.
No, you are not. And to understand why this law matters so much, you have to remember just the absolute Wild West we came from. Terra Luna.
Oh, vividly.
Right. People lost billions thinking they were holding dollars when they were actually holding code that just spiraled to zero. The Genius Act was basically the government slamming the door on that whole era.
So no more magic internet money backing these things.
Exactly. The core mandate here is the reserve requirement. If you issue a stablecoin in the U.S., you have to have one-to-one backing. For every digital dollar out there, there has to be a real U.S. dollar or a short-term treasury bill sitting in a vault.
Which, that sounds great for safety. If I have 10,000 USDC, I want to know the money is actually there. But there's a catch in the fine print. We've been calling it the boring clause.
Yes, the prohibition on interest.
Yes. This baffled me when I first read it. The issuer circle, PayPal, whoever, they're taking my money, they're buying treasury bills, and they're earning, what, 4, 5%?
Roughly that. Yeah, depending on the rates.
And the Genius Act makes it illegal for them to pass any of that yield on to me.
Illegal! Explicitly prohibited.
But why? Usually consumer protection's about getting people a better deal. This feels like the government making sure I get a bad deal.
Because it's not about protecting you. It's about protecting the traditional banking system. Think about it. If you could hold a digital dollar on your phone that was perfectly safe, backed by treasuries, and it paid you 5% interest, would you keep your money in a checking account paying 0.01%?
Absolutely not. I'd move it all in a heartbeat.
And so would everyone else. It would cause a massive deposit flight from the banks. The whole traditional credit system relies on those cheap deposits to fund mortgages, business loans, everything.
So the banking lobby basically made sure stablecoins were neutered.
That's a good word for it. They made them safe, but they purposely made them uncompetitive. They're dead money.
So for you, the listener, the takeaway is stablecoins are now safe parking spots. Not investments. They are digital cash under the mattress.
Precisely. But here's where it gets really fascinating. Even with no yield, the usage is exploding. We have a report here from State Street. They're projecting the stablecoin market cap is going to hit $3 trillion by 2030.
3 trillion. With a T.
3 trillion.
Even with zero yield.
Even with zero yield. And because of that one-to-one backing rule, that means stablecoin issuers are becoming some of the biggest buyers of U.S. government debt in the world.
So in a weird way, crypto is bailing out the national debt.
In a way, yes. But look at the geopolitical angle. State Street calls this digital dollarization.
Okay, break that down for us.
Well, imagine you live somewhere with high inflation. Argentina, Turkey, you name it. Getting a U.S. bank account is incredibly hard. But downloading a crypto wallet and buying a Genius-compliant stablecoin, that takes 30 seconds.
So you're basically importing the US dollar and the Fed into your local economy.
Exactly. You're swapping your volatile local currency for digital U.S. dollars. This strengthens the dollar globally, but it kind of hollows out the monetary sovereignty of those other nations.
It's like financial imperialism disguised as a tech upgrade.
I wouldn't argue with that description. It makes the U.S. dollar the operating system for the internet.
Okay, so that's genius. The law is set. Stablecoins are safe, boring, and apparently massive. Let's pivot to the mess, the Clarity Act.
The Digital Asset Market Clarity Act, yes.
This was supposed to be the big one. The rule book for everything else, Bitcoin, Ethereum, DeFi tokens, the thing we've been waiting 10 years for.
This has been the holy grail. The industry just wanted to answer one simple question. Is my token a security regulated by the SEC, or is it a commodity regulated by the much friendlier CFTC?
And Clarity proposed a surprisingly elegant framework for this. It wasn't just a static list. It introduced this idea of a life cycle.
They call it the maturity model. Think of it like a butterfly. When a crypto project launches, it's a caterpillar. It's got a central team. They're raising money. They're controlling the code.
That sounds like a security. You're betting on the efforts of that team.
Correct. So under Clarity, that starts in bucket 1, investment contract asset, SEC jurisdiction, strict rules, disclosures, all that.
But the whole goal of crypto, at least in theory, is decentralization.
Right. So if the project succeeds, if the butterfly emerges, and the network becomes self-sustaining, where no single person or group controls it, it matures. It graduates to bucket 2.
Digital commodity.
And it moves over to the CFTC. And that's huge because it opens up the secondary markets. Exchanges can list it freely. It becomes a tradable asset like wheat or gold.
This sounds logical. I mean, it actually makes sense. So why did it hit a brick wall in the Senate this week? It passed the House last summer. Everyone thought this was a done deal.
Because the devil is always in the details.
Yeah.
Specifically, the details around DeFi, decentralized finance.
The DeFi revolt.
It was a revolt. You had Heavy Hitters Paradigm, the DeFi Education Fund. They started digging into the fine print of how the act defined a regulated entity, and they realized it had a poison pill.
What was the pill?
It effectively treated software developers as financial intermediaries. The bill would have required DeFi protocols to perform KYC, know your customer, checks on everyone using them.
Okay, let's explain why that is such a deal breaker. If I go to a bank, I show my ID. Why can't a smart contract ask for my ID?
Because a smart contract isn't a bank branch. It's like a vending machine you put in a public park. Once a developer writes the code and deploys it, they can just walk away. The machine just runs.
Well, the developer literally cannot stop someone from using it.
Exactly. They can't block anyone, and they certainly can't ask for a passport upload. The code doesn't have eyes. So Clarity was demanding the impossible. It was saying, you must police your users, and the developers were saying, we built a system that by design cannot be policed. That's the whole point.
So compliance would effectively mean shutting down the entire technology.
Or turning it into a centralized Fintech app, which defeats the whole purpose. This is why Brian Armstrong from Coinbase, who is usually very pro-regulation, came out and said he could not support the bill as it was written.
And when Coinbase gets cold feet, I guess the Senate listens.
Senator Tim Scott hit the pause button. And now we're back in limbo.
The worst kind. So we have the Genius Act, stablecoins are sorted, but for every other altcoin, every DeFi token, every governance token in your portfolio, you're back in that legal gray zone.
Yep. The SEC and CFTC are still fighting their turf war because the referee never blew the whistle.
It's so frustrating.
Yep.
But, and this is the pivot point you mentioned, while we are all obsessing over Senate committees, there is something much scarier happening in the world of physics.
Yes. This is where we stop worrying about Gary Gensler and start worrying about Shor's algorithm.
We need to talk about quantum computing.
We do.
The outline mentions this concept. Harvest now, decrypt later. That phrase just sends a chill down my spine. What does it mean?
It's a strategy. It's being used by nation-state attackers right now. Think China, Russia, sophisticated groups. They are intercepting huge amounts of encrypted data, internet traffic, secure messages, blockchain data, and they're just storing it.
But it's encrypted. It's just gibberish to them at the moment.
For now, but they're hoarding it, waiting for the day a quantum computer is powerful enough to break that encryption.
So it's a ticking time bomb.
Essentially. And looking at the research here, specifically on Bitcoin and Ethereum, that bomb is ticking louder than people think.
Okay, let's start with Bitcoin. The notes mention pay-to-public key addresses.
This is a specific vulnerability. In the very early days of Bitcoin, the address format they used directly exposed the public key. This is called P2PK.
And why is that a problem for a quantum computer?
Because if a quantum computer has your public key, it can use Shor's algorithm to pretty quickly figure out your private key. And if they have your private key,
They have your Bitcoin.
they have your Bitcoin. Now, modern addresses are safer. They hash the public key so it isn't visible until you spend from it. But there are still millions of old Bitcoin just sitting in those vulnerable addresses, including maybe Satoshi's coins.
So if a quantum computer comes online, the first thing that happens is Satoshi's wallet gets drained.
That's the nightmare scenario. Imagine the market panic if 1 million Bitcoins suddenly move for the first time in 15 years. The price would crash to zero before anyone even knew what was happening.
But wait, most of us aren't using 2009-era wallets. For the listener holding Bitcoin they bought recently, they're safe, right?
Not entirely, because the moment you broadcast a transaction, you reveal your public key to the whole network. There's a window of time, 10 minutes, an hour before that transaction is confirmed, where a fast quantum computer could see it, derive the key,
Front-run you.
and front-run you.
And front-run you. They see your transaction, derive the key, and send a new transaction with a higher fee to drain your wallet before your original one ever clears. So the whole network just becomes unusable. Okay, so we just upgrade Bitcoin, right? Fork the network, add some quantum-safe crypto.
In theory, yes. But one of the papers we read analyzed the logistics of that, of migrating the entire Bitcoin network to quantum-safe addresses.
Let me guess. It's not a quick fix.
They estimated it could require 76 days of network downtime, or, severely degraded performance, to process all those migration transactions. Can you imagine the Bitcoin network being unusable for 2.5 months?
Catastrophic.
Yeah.
And that's just Bitcoin. Ethereum has its own quantum problems.
It does. The notes point to BLS signatures. Ethereum uses these for its consensus layer, for the validators, and they rely on the same kind of elliptic curve cryptography that's vulnerable.
But Ethereum is always upgrading. Surely they have a roadmap for this.
They do. They're talking about Ethereum 3.0, maybe around 2027. They want to bring in things like Starks or Winternet signatures.
Winternet signatures. That sounds like something out of a spy novel.
It's a type of signature that's very resistant to quantum attacks, but there's a cost. These signatures are much, much larger in terms of data size.
Which means higher gas fees.
Sky-high gas fees. If you thought gas was expensive now, imagine if every transaction signature was 10 times bigger. Network throughput would just plummet.
And what about Solana?
Solana has an optional Winternets vault, but it's not the default. It's a sort of break glass in case of emergency feature. But again, using it slows things down.
So there's this trade-off. We can be quantum safe, but it might make blockchain slow and expensive.
Exactly. But here's the connection that really keeps me up at night. If we connect this all back to the Clarity Act.
Oh, right. The law we just talked about.
Remember that maturity concept? The idea that to be a commodity, a blockchain has to be decentralized and essentially immutable. No central group controlling it.
Yes, that's the regulatory gold standard.
Well, how do you perform a massive system-wide upgrade to post-quantum cryptography if your code is supposed to be immutable?
Oh, I see where you're going with this.
If a blockchain is truly decentralized, organizing a hard fork to fight a quantum threat is a governance nightmare. But if you have a central foundation that can just push an update, then you aren't mature under the Clarity Act. You look like a security.
That is a massive paradox.
It is. The law is incentivizing these protocols to ossify, to stop changing, so they can be legally safe, but physics is demanding that they change and change rapidly just to survive.
So clarity might actually be a trap.
If clarity means you can never change the code again, then yes, it is a death trap in the face of quantum computing.
That is a lot to process. So we have stablecoins becoming the boring backbone of the U.S. Treasury market. We have the rest of crypto stuck in limbo. And we have a quantum computer that might break everything before Congress even schedules the next hearing.
It really just highlights the difference between human time laws, debates, committees, and technological time. Tech doesn't wait for a Senate markup.
So for you, the listener, looking at your portfolio right now, what is the synthesis? How do we organize our thinking?
I think there are 3 layers to your portfolio now. Layer 1 is stable coins. Thanks to Genius, they're safe. They're digital cash. Don't expect to get rich, but they will preserve capital.
Layer 2.
That's your altcoins and DeFi. These are high risk, not just market risk, but regulatory risk. Until something like Clarity passes, the SEC could sue your favorite project into oblivion tomorrow.
And layer 3.
Layer 3 is the existential risk. I'd call it cryptographic agility. You have to ask, does this blockchain have a real plan for the quantum era? And is its governance flexible enough to actually execute that plan?
Cryptographic agility. That's a great term. It's not just about financial diversification anymore. It's about technological survival.
Exactly. Because if a blockchain is too rigid, whether by philosophy or by law, it might just shatter when the pressure comes.
Okay, just before we wrap, I want to leave the listener with a final thought. We talked about how Clarity stalled because it tried to force KYC on DeFi. If the quantum threat is as real as these papers suggest, and these networks must upgrade to survive, does that mean they have to become more centralized to do it? Do we have to give up on decentralization to save the blockchain?
That is the ultimate question, isn't it? If you need a coordinated defense, you usually need a commander. And that goes against everything crypto is built on. It might just be that in the quantum era, a trustless system is a luxury we can no longer afford.
A cheerful thought to end on.
Always happy to provide the existential dread.
Thank you all for listening to this deep dive into the clarity or lack thereof in the crypto markets. Keep an eye on the Senate, but maybe keep a closer eye on the physics papers. We'll see you next time.
Stay agile.